So far, the stock market continues to rip higher, but are buyers getting exhausted? The economy does not have to be weak in order for the stock market to fall. And as much as growth stocks have ripped higher, to see any of that profit, you have to hit the sell button. And more than any other month during the entire year, September is historically where we see the most selling, where rebalancing of portfolios take place. Now, these are just the stats and the facts. It doesn't necessarily mean that stocks have to fall, but they're not in our favor. And it's going to be an opportunity to scoop some things up if they do in fact fall. But there are certain sectors that could perform quite well even if the greater market is falling. And in today's video, we're going to be talking about 3 very different ETFs. Each ETF is unique in the fact that they're not exactly the same. So you could in fact buy all 3 of these, but we're going to go through 3 ETFs to double up on right now. And before we jump in and unveil those, do me a huge favor. Show your appreciation for the channel, for the videos, by just simply clicking that like button down below. I truly appreciate it. It really helps the growth of the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we jump in, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could check out their 10 best stocks to buy right now. All right, let's jump back into our video, taking a look at 3 ETFs to double up on right now. And again, all 3 of these ETFs are going to be a little different from one another. And let's begin with IGV, which is the iShares Sector Software ETF. And if you've been watching of late, software has been doing quite fine. However, over the past month or so, we've seen a bit of a pullback, and there's been some high flyers that have led the pullback, notably Palantir. But when we look at an ETF like IGV, it's a good blend, a good mix of more traditional software type companies and these high-flying growth software companies like a Palantir. And when it comes to this AI adoption, this AI boom that we've been seeing over the course of the past few years, I believe it's going to come in phases. Phase 1 is really focused on the infrastructure, hence why chips are doing so well, data centers and things like that. The second phase, though, which we are entering into, is really going to center around software companies and the adoption of AI. Companies are going to be asking, how can I implement it to save money? And with this, especially in the software industry, there's going to be many winners and many losers. And when it comes to IGV, they currently have assets under management of just under $10 billion, an expense ratio of 0.39%, and in terms of performance over the past 12 months, the ETF's up 24%, and on a year-to-date basis, up just 7%. But they are down roughly 7% from its all-time highs. As I mentioned at the start, though, this is an ETF that's well-rounded. You have your more traditional type of software names that can be less volatile, but then you have your high-flying, fast-growing, which can really add to that performance while also bringing higher volatility. Think of the likes of Palantir. Let's take a look at the top holdings, where we could see the likes of Oracle, Palantir, Microsoft, Salesforce, Intuit, ServiceNow, Palo Alto Networks, Adobe, Synopsys, and CrowdStrike. In total, the ETF has 120 positions, with the top 10 accounting for more than 60%. As you can see right there, just in the top 3 holdings of Palantir, Oracle, and Microsoft, they make up roughly 30% on their own. But you have more of the legacy with Oracle, you have the fast-growing with Palantir, and then you have the big cap tech diversified name with Microsoft. That is a perfect example of the ETF as a whole. So if you're looking for extra software exposure and you're looking for an ETF that's well-rounded and maybe you can get some exposure to Palantir without going all in and investing directly in the stock, you get a good exposure rate with IGV. So definitely check this ETF moving into the close of the year. And that's going to lead us to our second ETF, which is going to be VIG, the Vanguard Dividend Appreciation ETF. And as I mentioned, all 3 ETFs we're looking at here today are different from one another. With this one, it's popular among the dividend investors, but not all dividend investors. There could be growth-conscious investors that like VIG because In reality, a lot of the companies that are within this ETF, they're not big-time dividend payers. The current dividend yield sits at just 1.7%, and they have a 5-year dividend growth rate of nearly 10%. So these are companies that still have a good amount of growth potential, but they do pay a dividend, usually a small dividend, hence why the ETF pays less than 2%. So you're getting the best of both worlds. You're getting a nice growth opportunity while also getting that dividend, which is more the icing on the cake. No one's investing in these particular stocks for their dividend, more so for the growth potential and the strong dividend growth. When it comes to VIG, the ETF currently has assets under management of $109 billion, making it the largest ETF on our list today, a very low expense ratio of just 0.05%, and over the past 12 months, the ETF's up 9%, and year-to-date, up 8%. So unlike with IGV that we just looked at a second ago, as that being a sector-specific ETF, all technology companies for the most part, this is more of a diversified ETF. So it really helps with the diversification in your portfolio. They are not married to any one particular sector. They're just focused on companies that pay and pay a growing dividend. As you can see here on your screen, let's take a look at the holdings breakdown, where the top sectors include technology, financials, healthcare, industrials, and consumer staples. And now moving on to the top holdings, which include Broadcom, Microsoft, JP Morgan, Apple, Eli Lilly, Visa, ExxonMobil, MasterCard, Walmart, and Costco. In total, the ETF has 340 positions, with the top 10 accounting for 33%. So with VIG, again, you get a good mixture of different sectors that are out there. But the top sectors are the one that I'm most upbeat on moving forward. Financials and technology. A lot of growth, and the economy is shaping up to really benefit these particular sectors moving forward. So unlike our software ETF that we looked at, although if you do need exposure, that's a great spot to look. But if you're looking more for a dividend growth type ETF that adds diversification, definitely check out VIG. And that's going to lead us to ETF number 3, which is going to be SCHD, or the Schwab US Dividend Equity ETF. And now we're really focusing on an ETF that is more for those dividend type investors. But the unique thing that you're going to find out here is not only are you going to get a much higher dividend yield with SCHD than compared to VIG, but the dividend growth is actually faster as well. When it comes to SCHD though, there's no beating around the bush here. It has been a major disappointment. But looking back, it's not all that surprising, because when the ETF went through its annual reconstitution, the top sector that came out of that was energy. And energy has been one of the worst performing sectors in all of the S&P 500 over the past year. So I hear the comments all the time, well, when they did the reconstitution, why did they select more energy companies? Well, there is no they. It is an algorithm. It has been an algorithm and will continue to be an algorithm on how the positions are chose for SCHD. There's no real human element. So given the performance that we have seen in SCHD, or I should say lack thereof, and we're going to look at that performance here in a second, but if any of you have followed it, you do know that this has been a lackluster investment, and it is a core position within my portfolio. But again, when it comes to SCHD, why am I optimistic right now moving forward? Well, right now we sit at all-time highs in the stock market. Right now we see a forward earnings guidance that is quite stretched from a multiple perspective, and the earnings growth expectations are quite high. Interest rate cuts, we know those are coming. Those are priced into the market. So there's a lot of things that are already priced into the market that can't really surprise us to the upside. That's how we look for catalysts up and down. But when we look at the opposite end of the spectrum, there are plenty of catalysts that can pull us down. Maybe interest rates don't come as much as we thought. Maybe they don't start when we thought. Maybe the earnings growth, it isn't as much as we were looking for. Maybe investors are getting tired of the high valuation. There's a lot more factors to the downside than there are to the upside. And that's where investors, especially during the month of September, could go through a rebalancing of sorts, looking at underperforming sectors to increase their exposure. And that could lead them all back to SCHD. When it comes to the ETF, they currently have assets under management of $73 billion and a very low expense ratio of 0.06%. But when it comes to performance, or lack thereof, over the past year, shares are pretty much flat, down just 0.3%. And on a year-to-date basis, they're up a measly 2%. So again, with SCHD, it has been a bad year. But on a bad year, quote unquote, this is what we get, pretty much flat. And that doesn't even take into account the income that we're receiving. With SCHD, it's not intended to be my high-flying growth generator. It's intended to be an income producer and a compounder of wealth through dividends. And speaking of dividends, you could see that right now you get a very solid near 4% dividend yield and strong dividend growth rate around 11%. And the dividend has been increasing for 13 consecutive years. A high yield combined with strong dividend growth is not something you find all that often. Now let's take a look at the top sectors, which include the likes of consumer staples, energy, healthcare, technology, and consumer discretionary. And the top holdings are Altria, Chevron, PepsiCo, AbbVie, ConocoPhillips, Merck, the Home Depot, Texas Instruments, Verizon Communications, and Cisco. In total, the ETF has 103 positions, with the top 10 accounting for 41%. So like we saw with VIG, SCHD is very similar in the fact that it's a diversified set of sectors. It's not focused on one particular sector. But unlike VIG, technology isn't a huge exposure here for this particular ETF, hence why it has underperformed in 2025. But that's also the reason I like it, because it is a great complement to tech-heavy portfolios, to strong S&P 500, that when they falter, SCHD is going to lift the rest of the portfolio. So there we just looked at 3 ETFs. One was a sector-specific ETF focusing purely on software, which is that next phase that I believe of the AI boom. And then we looked at VIG, which is different in many aspects to SCHD. VIG has a lower yield but higher exposure to technology. So you still get that growth potential moving forward. And then SCHD is a great complement to those tech-heavy portfolios. It helps offset so that when those sectors finally do take a breather, and they will, SCHD is going to be there to pick you up. And at the meantime, you're going to get a great 4% dividend yield and strong dividend growth. In the comments section down below, let me know, number one, which of these 3 stocks do you already own, and which of these 3 stocks are you looking to add at current levels? And if you found any value and appreciate the videos we put out, show your appreciation by just simply clicking that like button down below. And if you haven't done so, subscribe to the channel so you're notified anytime we drop new content, and we'll see you in the next one. Take care.